This is Cece. It is Tuesday, November 28th. We've got futures, again, down slightly, just like yesterday, but we're not seeing almost any volatility since we've started flatlining right before Thanksgiving. The S&P 500 seems to be stuck right here at about 45.50, and we have been going sideways now for days. Now, I wanted to sort of look at a couple of things. One is this consolidation that we've seen the last couple of weeks and this rapid decline in volatility, how that sort of played out in the recent past. And I wanted to look at the historical chart for this period. And this was basically last February. You saw this big decline in the SPX and then a bounce and a move back up to that level that this pullback or crash or whatever you want to call it started, mini crash. And you then consolidated, and if you remember, this was the beginning of that summer doldrums, and it lasted from April all the way really through. It went sideways for basically 2 months, and then we saw that breakout where it was that steady climb higher into the fall, of course, before we reversed, and we saw that volatility with rising interest rates and FOMC worries. And if you remember in the spring, this was back during some of those regional banking crises that was adding volatility to the market. But anyway, what happens is once you have that, that steep VIX decline from the 20s or in some cases when you're up near 30 and then you go to the low teens, you get that sort of gamma pin for a while before the market makes its next move. So I just want everyone to be aware of that. Now, also looking at this yearly chart, it's a good opportunity to see where we are with just about a month left in the year. And the S&P 500 is up almost 20%. And it is even a bigger move when you go over to the Qs side of things and the NASDAQ 100. This is up a whopping 46% on the year. So it's it's interesting to step back every once in a while. There was a lot of talk of the economy and a recession and stocks potentially crashing, and here we are going into year end with the S&P 500 up almost 20%, and the NASDAQ 100 Qs approaching almost a 50% move in 2023. So that just gives you some sort of perspective when you back the chart out a little bit of where we are. Now, speaking of that, we are at extremely low volatility, and we're looking at the Qs, and we've got this kind of flag forming where we're back up to these levels, and that potential for consolidation like we saw back spring is very much in play. We are watching this market go sideways for several weeks. That could last for into year end and maybe even to start January. If that's the case, again, that's a expected move seller's dream, a premium seller's dream where the market goes sideways. However, these are extremely low IV levels, as we've been talking about over the last couple of weeks. So you have to be careful with how narrow those expected moves are. Now, looking on the other side of that coin, though, that provides some big opportunity for those that are looking to position directionally, particularly into 2024. Now, that means that puts are cheap. Put spreads are even cheaper when you're selling some of that premium to finance the closer to the money premium purchases of puts. So those looking to hedge into 2024, if you've seen gains in, the Qs type stocks, like those big cap tech stocks, and you want to hedge some of those gains on the year, it is a great time to do that because the IV is so low, you are going to be able to get very inexpensive hedges into 2024. And for those still bullish in those stocks and looking for long-term holdings, that is a great opportunity because you do not want to have to take profits into year end for a number of reasons, and you want to hold those. And so, there's potential here. Obviously, if you're looking out, you would pick a time frame. You could even go all the way out to September of next year on this chart. What's kind of amazing here is that's a 13.8% expected move all the way out, almost almost a year, but out to the end of September. And we have seen moves. I mean, what was this move? So this move was 13% from these lows just over the last month or so. And that's what the options market is pricing out until September of next year. So that gives you an indication of just how inexpensive options are. So if you were looking at this and you're like, all right, we just got this big move on top of this big 46% move, a hedge there to that expiry, boom, you've got a put spread. You see what you're risking. You see what the reward is. It's about, a little bit more than 4-1. And those are the kinds of inexpensive, and then you could be looking at straight puts out of the money. You could buy a put down at that level as sort of a disaster hedge if the year started off rough. And so, those are the kinds of things you're looking at. Now, going back to this sort of pattern forming on this chart, if we were to see a breakout in 2024 from this chart, calls are cheap too, right? And so if you were looking for, and not necessarily in the Qs, this could be in individual stocks, this could be in IWM if it was playing catch up. This could obviously be in the SPY if it started playing catch up with the big cap tech stocks. The call spreads, calls out into 2024 are very low vol. And so that is something to keep an eye on. If you were looking at one of your favorite stocks, pulling up this chart, seeing these expected moves, seeing how the stock, what it would take for a stock to move 10%, seeing how the options market is pricing that, and then price up some call spreads, price up some calls, see where your break evens are. And that is, one of the things to do is when